Is TTWO stock on the verge of a massive breakdown, or is this the last great buying opportunity before an explosive rally? Take-Two Interactive is currently flashing a mix of confusing technical signals, and the short-term trend is looking noticeably shaky. Yet, despite the recent selling pressure, a wave of vocal analysts are insisting the stock is incredibly undervalued right now. Who has this right, and who is about to walk straight into a brutal market trap? Let's look at exactly what is happening behind the scenes. Take-Two Interactive, trading under the ticker TTWO, is one of the absolute biggest heavyweights in the global video game industry. They own legendary powerhouse franchises like Grand Theft Auto, Red Dead Redemption, and NBA 2K. The stock is under intense market scrutiny right now because the gaming sector is navigating a massive transition period, development costs are skyrocketing, and everyone is hyper-focused on their upcoming launch timeline. Before we break down the charts and numbers, do me a quick favor. Smash that like button, subscribe to the channel right now, and leave a comment below. Seriously, drop a comment with your blunt prediction. Is TTWO a screaming buy right now, or is it a dangerous trap? Let me know your thoughts, and let's get straight into the data. When you analyze the technical charts, the situation gets highly complex. The medium-term price action has shown a clear grinding downward channel with lower highs and lower lows. Short-term momentum indicators like the RSI show deep weakness, hovering close to oversold conditions as sellers repeatedly push the price down. Every minor relief rally over the past few weeks has been aggressively rejected at key moving average resistance levels. Volume spikes have primarily been on down days, indicating that institutional players might be distributing shares. However, we are now fast approaching a historically strong horizontal support zone that has held firmly during past market corrections. If this support holds, it establishes a perfect base for a massive double bottom reversal. But if it breaks, the technical floor completely drops out, opening the door for an accelerated move downward. This persistent technical weakness is exactly why Wall Street remains intensely divided on the stock's direction. Looking at the latest consensus ratings and quantitative signals, sentiment has turned noticeably cautious. We have seen several high-profile downgrades to hold, and even a few sell or strong sell ratings hitting the wires. Analysts are raising red flags over shifting player monetization trends, rising operational costs, and the risk of game delays hurting near-term earnings. Multiple algorithmic trading models are flashing negative short-term signals, keeping the immediate outlook incredibly murky. This sets up the ultimate debate dominating the financial boards. Is TTWO genuinely undervalued, or is it a classic value trap? The bulls firmly believe the stock is on sale. They argue that owning TTWO is all about buying intellectual property that will generate billions in high-margin revenue for years to come. They look past the temporary dip, viewing it as a rare gift to accumulate shares of a premium entertainment giant before its next major growth cycle kicks in. The bears, however, scream value trap. They point out that the stock trades at an incredibly high valuation relative to its current trailing earnings. They argue that any delay in their major release schedule would be a catastrophic blow to the company's financial guidance, meaning investors buying here are simply catching a falling knife. The downside risks here are massive and cannot be ignored. The video game industry is notoriously volatile, driven by hits and expensive development cycles that can take half a decade to materialize. If a flagship game misses its launch window, or if post-launch monetization fails to hit expectations, the stock gets punished instantly. This exact volatility is why retail traders get trapped so easily. Retail buyers see a recognizable name dropping, assume it's cheap based on hype, and buy in blindly without understanding the underlying fiscal calendar. They fail to realize that institutional sellers can keep applying pressure for months until the macroeconomic backdrop actually turns favorable. Let's map out the absolute best case and worst case scenarios for the stock. The bull case relies entirely on a flawless execution of their release pipeline. If their next major title launches on time to record-breaking sales and drives massive recurring player spending, TTWO's cash flow will skyrocket. This would trigger a wave of aggressive Wall Street upgrades, sparking a massive short squeeze and a violent rally back to fresh all-time highs. On the flip side, the bear case is a nightmare scenario of unexpected delays or weak reception. If high interest rates continue to squeeze consumer discretionary spending and development timelines stretch even further, revenue will shrink quarter after quarter. This would force analysts to aggressively slash their future earnings estimates, triggering a vicious continuation lower that could wipe out years of shareholder value. When deciding how to play this stock, you must clearly separate the short-term outlook from the long-term perspective. In the short term, expect highly choppy, frustrating and volatile price action. The negative technical momentum and cautious analyst commentary will likely act as a heavy ceiling over the stock for the next few quarters. But if you lift your gaze to a 3 to 5 year horizon, the fundamental landscape changes completely. The global demand for premium interactive entertainment is growing, mobile gaming expansion continues, and Take-Two's portfolio remains world-class. So, what is the ultimate move here? Are we looking at a temporary cyclical low that will reward patient investors with massive wealth? Or is this the beginning of a fundamental breakdown that will crush anyone bold enough to buy the dip? The charts are screaming danger, but the long-term fundamentals hint at massive potential, leaving the entire market guessing what happens next.